Corporate finance practice problem using Onenote. Dividend payment policy. Get ready, it's time to take our chance with corporate finance. Here we are in Onenote. If you have access to Onenote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side. We're in the practice problems tab down in the 1832 dividend payment policy tab. Also note, when using Onenote, look at the immersive reader. Our presentations will be down in the text area too. Same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have our information up top, calculations on down below. We're going to do some different kind of ways where we might think about or see a dividend type policy being set up. Scenario then down below, we've got the years 1 through 5. We're going to imagine the net income or projected net income for the years 1 through 5, and then our capital expenditures. In other words, the expenditures that we think that we could invest in and get a return that would be better than the return, or a return that we think is sufficient for the company in order to retain the money in the company and invest in it, as opposed to taking that money and giving it to the owner in the form of dividends so that they can then take it and invest it any way they would like to do. So remember, that's kind of the general idea when you're thinking of this from the ownership standpoint, from the shareholder standpoint, and those are the owners. Then the question is, well, should we be retaining or holding on to the dividends, or should we be giving them back to the owners? From the owner's perspective, the perspective may well be that, well, if you're getting a return in the corporation that is greater than the return that the owner could get if they had the cash themselves and invested it somewhere else, then it may be worthwhile to then invest it within the corporation, retaining the money, using it then to invest in equipment or whatever we are investing in to get that greater return, because that greater return then maybe can be used for dividends in the future or increase the value of the company itself, increasing the value of the stock. If not, then the owner would be better off if you give them the money in the form of dividends so that they can take that money and go invest it somewhere else in some other area and get a greater return in on it. So that's kind of the general rule, but it's a little bit complex to see sometimes from the ownership standpoint exactly the dividend policy, if it kind of jumps around depending on the net income versus the capital expenditures project. So sometimes a corporation might try to do something more simplistic. They might then just say, hey, we're just going to take a portion of the net income and pay it out in dividends so everybody knows exactly what's happening. Fairly straightforward type of system that is quite transparent. Or they might have it more complex in that they're going to be doing something with stock dividends possibly, and some form of dividends that would be in cash dividends, some type of combination such as that. So we could have different scenarios. It will depend then on the corporation, the owners, what the owners want for it, and that could change from industry to industry, corporation to corporation, where they are in the life cycle. So let's go on down. We got the shares outstanding at the 2 million. We have the marginal principle of retained earnings. That's going to be what we discussed first, generally, being the general idea that the shareholders would be best off if you can get the return that you want to get the return on the money that you can get the return on, which we expect to be greater than what the owners can get the return. That's what we will keep. That's what we will retain. That's what goes into the retained earnings and not get paid out in dividends, because we're going to use it in the company to get that return. And the difference then going out to the shareholders so they can then get a return on the dividends for that portion. So if we look at that from that perspective, we've got our years 1 through 5. We're just going to then pull our income numbers down, same income numbers as we had up top. So we're just pulling that down. We're pulling up our capital expenditures down as well, and then we'll just subtract them across to determine the dividends that would be going out each year. So if net income, in other words, was 19 million in year 1, and we think we can take that money and reinvest it in the company, like in equipment or something like that, building, whatnot, and get a return on it that is sufficient for us, sufficient being greater than what we believe the owner could get, then we're going to retain that, and that's going to be the 7 million. So the 19 minus the 7, that means dividends would go out at the 12 million. So the owners could then take that cash and invest it where they want, putting the money to work for themselves on the 12, and the company put in the 7 to work. On year 2, we got the 22 million, and once again, 10 million we're going to assume that we can put into a capital project, getting the return that we want. The difference then of the 22 and the 10 at 12, once again, the dividends that would then go out to the owners so that they could invest it where they feel best to invest it outside of the corporation. Year 3, we got the 17 million for the net income. The capital expenditure we're saying is 9 this time, and so that means the difference being 8 that would go out in the dividends, 8 million out for the dividends. Notice, of course, this determination of what we think we can invest in for the capital expenditures may vary from year to year, and that could result in some fluctuations. So the income levels could, of course, fluctuate, capital expenditures could fluctuate, and therefore the dividends may be less predictable. They might not be an even trend of the dividends this way, although they could maximize or may be seen to maximize the results to the owners. But it could also cause some confusion. Like owners might want to see a nice even increase in dividends. Owners, if they're glancing at the corporation, tend to like to see a nice even increase in income, a nice even increase in the dividend outflow, and so you could have some pros and cons depending again on who the owners are, how sophisticated the owners are, and what actually their objectives are as to their interpretation of different dividend policies. So year 4, we got the 16 million. Minus the 11 million capital expenditures gives us 5 million on the dividend, and year 5, 24 million on the net income, 12 million on the capital expenditures, giving us the 12 million at the dividend level. If we add up the dividends for years 1 through 5, we get the 49 million. Then you might have a policy, a more simplistic policy. So if we might have a policy that just says, hey, we're going to give 15% of the net income, that is what it is. Now, this might not be optimal in the same way as we would think that the system up top could be optimal. However, the system down here would be easier for people to interpret. And if we still have, if we have the money that we need in order to invest back into the company, then that might be a good policy to go with. And again, it kind of depends on what the growth rate of the company, where are they in their business cycle, and what do the stockholders want, what do the shareholders want. Oftentimes they might like the dividend policy at a straight rate of the earnings because again it's simple for them to see, simple for them to calculate. They can basically they know what to kind of expect with something like that. So that would look something like this. Of course, we'd have years 1 through 5, and then we got the net income at the 19 million times the 15% going out. So that would simply be, of course, the 19 million times 0.15. Hold on a sec. An added 0 got in there because my finger, I think my fingers had a fat finger moment, times 0.15. There's the 2,850,000. And then that's what ruined my guitar career is fat fingers. I'm blaming the fat finger. Anyway. So then we got the 22 million net income times the 15%. Once again, we're at the 3,300,000. And then the net income year 3 at the 17 million. And we got the nice 15% of that, 2,550,000. Year 4, 16 million at the net income. We're going to be taking the 2,400,000, 15% of it. And finally, year 5, we got the 24 million, taking 15% of that, gives us the 3,600,000 for a total dividends of the 14,700,000. So notice that if the income has a nice increase, it doesn't exactly here, but if it were, then of course the dividends would follow that nice, a nice increase in income over the years, and that's usually the kind of trend that investors like to see. And again, this one gives you some more predictability. Let's try another one, a little bit more complex. Let's spice things up. Let's throw some salt and some paprika in the calculation, some other spices. So this one's going to be a stock dividends for years 2 through 5, where we have the 20% stock dividend. And we're also going to be giving out the 2.75 per share. So we got this double layer thing, stock dividend in the mix. That's spicy. That's really spicy. Make sure you got some milk when we do this one so your mouth doesn't get too hot. Okay, so we got the total shares. Starting off, this is going to be a running balance type of calculation. This is a really good calculation to basically practice in Excel. So if you haven't worked this or you want to work this in Excel, we have it in Excel. You can check that one out as well. So we got the 2 million. 2 million, we're going to say there's a stock dividend of the 20%. So the 2 million times the 0.2, that's going to be the 400,000. The 400,000 plus the original 2 million is going to give us the 2,400,000. And then we have the stock dividend in year 3. So stock dividend, more stocks going out, times the 0.2. We got the 480 stocks going out, plus what we had before that at the 2,400,000, means now we're at shares of the 2,880,000. And then we have a 20% stock dividend, we're going to say, times 0.2. That's going to then mean we have shares outstanding of the 576,000, plus what we had before the stock dividend, 288,000. That's going to give us then our 3,456,000 stock dividend year 5, finally, and conclusively are ending on 0.2, 20%, giving us then our 691,200 plus what we had on the dividends before that, the 3,456,000, and that's going to give us our 4,147,200 shares. Now, if we're going to then be given the 2.75 per share, that'll change per year given the fact that we had the stock dividend, changing the number of shares that are out there times the dividend up top. So, and note, when we did this running balance calculation, like I said, that's a lot easier to do in Excel if you do an autofill calculation, useful calculation to practice with. So practicing Excel is fun, as the Excel is fun person says. There's an Excel is fun person, and Excel is fun. So that's good. So anyways, the 2 million times up 2.75, it's going to give us the 5,500,000 for the dividends in year 1. And then in year 2, we got the 2.4 times the 2.75 is going to give us the 6,006,000. And then in year 3, we have the dividends of 288,000 times the 2.75. That's going to give us the 7,920,000. And then in year 4, we've got the 3,456,000 times the 2.75, giving us the 9,504,000. And then finally, I won't even do the last one, but it's going to be the 11,404,800. Adding up the dividends in the outer column, we're at the 40,928,800 for the 5-year period. Okay, let's do one more, which is even more spicy. This one has a lot of spice. Okay, so we got the stock dividends, we got the 20% dividend thing with the stock dividend still, and then we just have the payout ratio at the 30%, which is basically a net income calculation that we're going to have, and we're going to add on to it the dividends per share calculation at the end of this instead of just simply the total dividends. So let's check that one out. The first part we've done before. It's spicy hot, but we've seen it before. So like our taste buds are already burnt off, and so it's not going to be as bad this time when we do the same spice. So now we're going to say the 2 million times the 0.2 for the stock dividend, once again giving us the 400,000 plus the prior 2 million, and that's going to give us the 2,000,004. Also note, when looking at this kind of situations, just setting up the table is half the battle, like G.I. Joe, but you got to set up the table, and so you might want to practice doing it in Excel or just on paper or something like that, and practice setting up the table if you're expecting to do problems such as this and like a test situation or something like that. Really good practice just to practice setting up tables and visualizing how it might look to make it as easy as possible. You'll get better and better at that. So you got the 2,000,004 times the 0.2. That's going to give us the 480 plus the 2,400,000. That's going to give us our total of the 2,880,000 times the 0.2, which is going to give us the new shares of the 576 plus the prior point we were at, 288,000, which is going to give us our 3,456,000 times the 0.2, which is going to give us new shares of the 691,200 plus the 3,456,000, and that's going to give us once again our ending point of the 4,147,400. Now the net income was given to us, so that's no change. We're just taking that net income, bringing it on down. The payout ratio means we're paying out meaning paying out in the form of dividends of the net income. So we're paying out of the net income 30% this time. So we have nothing to do with these new shares. We're just taking that net income line times the 30%. So that's going to be net income 1900000 times 0.3, 5,000,007. I'll just do a couple of these and then I won't do all of them. It's going to be the net income there's two twos. 00000 times 0.3. That's going to give us our 6,000,006. And then we've got the 1700000 times the 0.3. That's going to give us our 5,000,001. Then if we take 30% of the 16 million, we get the 4,800,000. 30% of the 24 million, we get the 7,200,000. Then we're going to take it one step further than we did before. That's like the last step, like with the last ones we did, but now we're taking it one step further to the dividends per share calculation. And that's going to change now because that's where we're getting into play these dividends changing from year to year. So if we do that, then we're going to take year one. We had the 5,700,000 divided by the number of dividends of the 2 million. That means we got the dividends per share of the 2.85. Then what happened next time, year two, we had the 6,600,000 divided by the shares 2,400,000, and that's going to give us our 2.75. And then the next year, year three, 5,100,000 divided by the 2,880,000. That's going to give us our 1.77 about. Then in year four, what happened? We had dividends of the 4,800,000 divided by the 3,456,000. That gives us the 1.39 about. One more time. This is the last one, and we have to stop after this, so make sure you enjoy it. Enjoy this one. It's the last one. 7,200,000 divided by the 4,147,200. That's going to give us our 1.74 about. Then, of course, we can total some of these up. Total dividends at the 29.4 in total. You can total the net income up for the 5 years and total up the new shares over the 5 years if so choose. So note, of course, we can have various kinds of dividend policies. The dividend policies that would be in place are going to differ from corporation to corporation. It'll differ depending on the industry that they're in. It'll differ on the size of the company, in the business cycle that they're in, and in the preferences of the shareholders in terms of what they desire with regards to dividends, consistency of dividends, maximizing the return and whatnot, and those types of policies.